Hello, ladies and gentlemen, and welcome back. Dumb money versus smart money. We all want to be smart, right? Well, today we'll be taking a look at what most people are doing in the markets. We'll also be looking at the hedge fund managers, seeing their positions, understanding what they're trying to achieve, talking about PE ratios for investment reasons over time, and of course, looking at the key levels that we need to be watching in the market. The market's just picked up to the golden pocket. That's between the 61.8 and 66 Fibonacci level. We've seen a rejection, but we haven't quite made a new lower low. We'll be talking about the things that kind of show us that the market is potentially moving to the downside and that this rally may be over. And we'll also be discussing, of course, some things to do with stocks, commodities, and cryptos. All the markets are interesting right now, and that makes for a great video. See you soon. Well, welcome back everybody to the Daily Show where we talk about markets around the world. We'll start with the macro data, go into the lead indicators, talking about yields, and of course, then finish up with all of the key levels we should be watching right now. If you like markets, subscribe and smash that like button because I think you'll find a lot of value in today's video. Let's talk about smart money versus dumb money. So we've used this chart a few times this year to show us cross points. That is when dumb money outweighs smart money, we need to be concerned. You can see the peakings here of the market, and we have just made a big switch. Now, smart money, funnily enough, is actually coming with this particular rally, which is the first time we've seen it. And that's because the CPI data was positive towards the inflation side. Obviously, we're seeing now a turn of inflation that's been relatively consistent through the last couple of data reports, and that's leading to potential rallies in these markets. Is the breadth showing us a similar thing? Well, we'll take a look at that in just a few moments. What about trend following funds? What are these guys doing? What are the big funds in the world doing? Well, the commodities traders, they're effectively, if you're taking them as an overall rule, they're not actually very long in exposure. Now, this is important to understand because a lot of people think that a lot of these big hedge funds, they all pick the bottom and they're all like, yes, let's go. Actually, a lot of rallies, and the reason why rallies start to speed up is because they have to, and they have triggered into purchasing levels if they miss the bottoms. What that means is they must beat the market. Otherwise, they don't get paid the sweet commissions, yeah? So if they don't get those sweet commissions, they're not going to have a good bonus during Christmas period. So if the markets continue to rally and they miss it, often they have to pile in. And at the moment, they're still net quite short. In fact, they're underneath negative 10% in terms of their overall positionings. Now, this has boded well in terms of annual returns. When we tend to see spikes that are extremely low, you can see that that correlates actually quite well with the markets coming up. When everyone's bearish, you might want to be starting to think about being bullish. Of course, that's a Warren Buffett concept, fear and greed. What about hedge funds? Well, across 4 different strategies, we're also seeing a pretty low purchasing of stocks. Again, the below 5% reading tends to be pretty positive for annualized returns long term. But it's important to note that this is what's occurring. We're not as low as we were anywhere near the GFC though. So we still haven't seen that really high capitulation fear, which tends to bottom us off in most market conditions. Let's now talk about PE ratios. Now, a lot of you guys will say, PE ratios, what a waste of time. You know, it's not like these are telling us much. Well, I like to think about it as a world. So if we take all countries in the world, we're sitting at about 14.2. So it's not exactly super expensive. Emerging markets are at 10.5. You can see here the green line, kind of in line with pretty much the last decade. And the US still very high at 16.8. People have cottoned on to the US being the best market in the world to invest into. And that's been the story of the last decade. Some of the biggest innovative companies, people have wished that that was the one they wanted to be in. And you can see the compression of the US back when the tech bust happened was pretty severe. They all actually came in line around here, and then we all busted during the GFC in accordance. So are we at a cheap rate? Well, we're at an okay rate. You can kind of see here the 16.8 is neither expensive nor is it cheap. When we break it down a little bit more and we look at forward PE ratios, you can see here that the SP 500 is still relatively expensive, but the actual SP 600, that is the smaller stocks as well, is not necessarily super expensive off its peers. And this is where I think the interesting component sits. We're actually back to 2020 lows on this one. So this is the hyper stocks and a lot of those high PE valuation stocks that have been absolutely smashed upwards of 90%. They're back down at levels that are a bit more I guess you would say, reasonable. When we take out the mega caps, you can also see the underlying market here. And taking out the mega caps, it gets a little bit cheaper again at 15.3 and pulls it more in line with, I guess you would say, pre-pandemic normals. So has the market done a good job of resetting itself? It's reset. It doesn't mean that it's cheap yet. It's on that kind of average. It's not a standard deviation cheap, which is what a lot of more value and more, let's say, call it patient investors would be looking for. But that may be reached. If we hit something like a 32.60, that's definitely a possible level. So what are the bull cases right now for markets? Well, it has to be this breadth. The breadth percentage above the 200-day moving average. We've dropped twice. That's, of course, created these new lows. We've made the new lows similar to 2016-15. And we're seeing a pretty strong pickup from that point. We've actually now made a double bottom on the breadth. Now, this means this is one of the best indicators traditionally with the stock market. It's been very common to be falsely broken in 2022. So we have to be very careful with breadth and thrust. We've seen this a few times. It's begun rallies, but then they've ended just as quickly. The data-dependent Fed will be really what changes this. We just saw core retail sales come out. They were a bit hot. The market didn't really like that. Obviously, we start to see some more inflation numbers getting bad. The UK wasn't good either with those numbers. If the US prints one bad number, get ready for the pain train of these markets. Otherwise, this really could be the beginning of a rally, but we don't know that just yet. We'll explain that with some lead indicators a little bit later. Also, remember, the economies are getting sick. Layoff news stories are surging. Everyone's firing everybody. So unemployment is definitely on the rise. That is technically what the Fed probably wants. Yes, they want max employment, but at the same time, they don't want the economy, really out of control, which it was. So we have to expect this, and I would expect this to be the story of the next 6 months. Unemployments and layoffs, unfortunately, will be rising around the world. Now, just a quick announcement before we get into the live charts and we have a look at everything. We will be doing a little special thing for Twitter followers. So jump on over to @FXEvolution and follow us over there. If you're interested in getting some of the reports, we do have in our private community, free 7-day trial. If you're interested to join this down below, this is just an example of one of the newsletters we put out over the last 24 hours and just for one of the pairs. So it just shows you a little bit. We'll be posting that once a week onto the Twitter. And if you're interested, you can follow along there, or of course you can sign up for our cheat sheets, our free cheat sheets, and we'll be sending them out in a newsletter as well if you prefer to have them there. So we'll send that out once a week, just a little bit of extra something for you guys to have a look at and see how we start to approach markets a little bit differently. What about earnings season? Well, the beat rate is terrible. I mean, there's nothing good about this. The beat rate is 56%. It's bad. It looks bad. If it continues to be like this, the economies are sick. We'll jump into the options very soon as well, because as we know, there's trillions of dollars just about to expire, and that's going to be the big story of the next 2 days. But I want to just talk about, again, the AMC, SP 500 kind of thing. If we continue to see AMC rally, and we've had that kind of before, then it has been a good sign that the market's starting to top off. We've had a nice uptick in terms of percentage for AMC. It's definitely gone up a bit. Just to put this in perspective, if you'd bought the bottom down here at the top, it was up about 61%. So we're starting to see a rally through the FOMO kind of devices. I call AMC the FOMO because it shows that risk is back on and people are prepared to take risk. It usually shows calls are going through the system. But this is just something that we'll continue to watch, and it has been a good precursor to maybe problems in the underlying market and a good sign to say, okay, the FOMO is coming back in. Maybe I need to be a bit more careful about the buy side of the market. What about the VIX? Well, the VIX continues to drop here. It's just stabilized throughout this 24. It's neither high nor low. We're not at the extreme 20, which has been synonymous with, of course, the rallies in terms of VIX rallies and markets dumping, and we're not really at any particular key point here for this. PCC, put call ratio, that actually jumped. So quite a lot of puts coming in over the last 24 hours into the markets, a full switch in terms of people going negative. We know this options expiration is massive. We'll look at that a little bit later. US 2-year yields, they went up slightly, market came down slightly. No major moves across the yield curve. It still looks like this, hitting a terminal rate of around 4.8+%. And that is going to happen in 2023, approximately March, April. We'll then stay there all the way till September-ish, and then maybe have 1 or 2 drops through that December period of 2023. So expect incredibly high terminal rate, but it's still down from where it was when it hit 5% only a few weeks ago. That CPI number certainly helped out. Let's go and have a look at the dollar index. We know the US dollar major is the key. Let's look at the daily first. Here it is. Here's the daily. Very key level. There's no doubt that this is a very nice zone to see the markets bounce off. We had that missile, I guess, which made people go into a safe haven that pushed the US dollar up straight off this level. And when we go down to the 2 hour, you can really see that the previous pullback was met by the golden fib, and we actually started rising back up. Now, to say the US dollar has found strength, no, it hasn't yet. It's found a rejection. It hasn't found incredible strength. I'd like to see the US dollar strengthen heavily coming into this options expiration. And I've got an alert sitting here at around 107 kind of 18, just to show us that the market is willing to go up. I think 107.25 would be a good breakout level, and that would show us solidified strength here in the US dollar. At the moment, it's still technically a bearish market for the DXY, but it hit an incredible target. So for shorters, I'm sure some profit taking was had. What about the euro? Well, it's kind of like a carbon copy. Euro hit this critical little level here, this daily kind of close that was there, some supply coming through. It's rejected. We have an alert set for the sell. That's going to set around 102.65-ish. I'd like to see the market come down, rally, and then look towards the sell side on this. But we haven't seen that yet, and euro remains in an upward trend. What about gold? Well, gold's coming to some serious levels. If we go to the daily, this was the zone that stopped gold only just previously. Now, I've got alerts setting all over this thing, but that's because this is what I like to do. Set alerts, wait for the market to do something, have the patience to react, don't predict. If you're ever interested in this type of stuff, definitely jump over to fxevolution.com and we'll be having a sale, I believe, in about a week for Black Friday. So if you're interested, this is part of that advanced scalping masterclass. It's certainly a big game changer, I think, for a lot of you guys out there. Let's now talk about gold, though, because gold's entering monstrous supply zones. This has been a rally. I'm pretty happy with, I'm not going to say I'm not. I'm pretty happy with what gold's been doing. It's been rallying and rallying and rallying. Unfortunately, it didn't come back for most people. Like we were kind of hoping maybe this and that would be pretty sweet, but it just went rally, 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 rally. It's coming in like a freight train to this level, and it's actually just reached the box. So let's have a look at the 15-minute and let's check out what's happening. It's dull. Now, you don't really want to short a dulling market. So that is, it's going up with higher highs and higher lows, but it's grinding higher, and you'll notice I've got alerts sitting around these kind of 1766. And the main reason I have those is because I want to see a lower low being formed and some sign of weakness. Tough short here. Certainly nothing going on just yet, but it's reached this level. For now, the trend is still up. We'll, of course, update on the daily whether we believe that potentially the trend has changed, but at this stage it hasn't. Oil still looks weak. I'm pretty bearish on oil overall. I think I've made that pretty clear. Obviously, a lot of you fought me in the comment section saying the stocks are going up. Yeah, stocks and oil, the actual barrel, are a different trade, but certainly we're finding weakness still here in the oil. I think that's demand destruction in play. We're back to $84.85 a barrel. Do we go back down to these 76s? My eventual plan for oil is to get back to the 65 a barrel. I think that's going to happen over time. We'll find out whether it does. Of course, the main fight against that would be green energy and the fact that we're going to need a lot of oil. But I do think demand destruction, what the Fed's trying to achieve, is hurting the barrel here. So we've got some weakness and we have multiple different demand zones here. I'm not going to probably do anything with oil. I know it's making lower highs. It looks weak, but it could easily just go bang, bang. And what I've got is an alert set above 90, just in case it rallies through, so we can look to this. I would say I'm neutral on this pair at this stage. I don't, other than a longer term objective, I don't really have too much opinion. Copper, what's going on here? Weakness coming through, again, rejecting, coming back to maybe these alert levels. If copper continues to weaken, that could mean it's a false break on all of these things to do with the economy improving. We had in our previous video, when copper spikes the percentage it did, that's usually a very positive sign for markets, but the next 1 to 2 months can be kangaroo style. That is, markets may actually go down, but overall it was a positive sign. So Dr. Copper just relaxing a little bit after a huge move up. We could see some form of buying to come through around 365. we'll update on this. I don't actually trade copper. I just like to look at it as an indicator. Let's move into the stocks now. We'll start with Aapl. And Aapl actually looks like it's creating a small head and shoulders. Take a look at this. You've got the left shoulder, the head, the right shoulder, and you have this massive kind of demand zone. If we break through, could we be moving down to fill the gap? Could that be the sign? Well, you'll notice when we look at the indices, a lot of them are at those critical demand levels. And if they start breaking through, it does kind of signify further weakness in the markets. For now, still bullish on this pair. Nvidia's come out with its announcement. I think it was up after hours, but interesting. Island reversal here, guys. So we had the gap up, the gap down. I saw a few people in the public Discord going crazy about this one. Fair enough, guys. Well done to you. And yeah, it was a decent short for the session. Certainly quite a nice looking trade. And at this stage, I guess you're looking towards weakness again in Nvidia. But the next 24 hours, because it's back on that support level, will be important. We need to see the SP 500 also fall through the key zones. Tesla's remained pretty weak. It's pulled back quite a lot more. It was down 3.86% on the day. And that's not good. I mean, Tesla does not look good. I repeat, this is not the type of foundation that I'd like to see. I would have wanted more rally. It's dropping without the rest of the market dropping. What happens if the rest of the market drops? Does Tesla fall through this 180? You know, we like 180. We certainly liked it the first time, but I don't really want it down there again. So I think Tesla traders are looking towards this being the positive sign for it, breaking through that 200 plus. And if it does break underneath, you know, I say that because I'm a bit scared. There's nothing much there. We have a gap that fills at 136, and it could be quite ferocious, I think, for Tesla. So be careful here. Keep an open mind, even if you're a Tesla lover, too, when it comes down, because maybe you're a Tesla lover, and you're thinking, okay, well, I want the cheap price. There's not much in here. I mean, maybe you're seeing something I don't, but I don't see much structure in here, and the gap fill would be down, and that would be quite a big negative. Remember, Tesla is one of the best performing stocks of this year when you think about it from a perspective of how high the valuation is and how it's been going. If it misses on the next earnings, which happens in 23, that will be disastrous for it. A lot of volume coming through as well. Look at these volume switches. So depending on the price action moving forward, it could be very, very interesting to take a look at it. Let's have a look at the 2 hour as well. Again, gap up, gap down. Another nice short day for that one. That was a pretty good trade for anyone that took it. XLY, XLP, the combo of the American consumer because of Tesla and Amazon failing a little bit in the last 24 hours has come down. This is still not traditionally what we see with a recovery in the market. So we have to be careful there because it's not the traditional way. The old economy versus the new economy, Dow versus S&P 500 had one of the better sessions it's had in a little while. We'll go to the daily just to prove that. And again, it's not really what you want to be seeing. If we believe the markets are recovering, we should see the S&P 500 outstripping the Dow. And that's because the tech companies and the big kind of, let's say, innovative companies should be beating it. They're not doing so at the moment. Again, it's just a little warning sign. We've got to be careful there, at least in my opinion. Let's move over to the NASDAQ. What's going on there? Well, it hit the 12,000 plus. Nice. It's rejected. Nice. It's come back down to the demand zone. Interesting. We have an alert sitting underneath there. Price-wise, we're looking at around 11,659. If it does break, of course, we're expecting something like this to occur, or maybe it just dumps straight in, then pulls back. There's still some supports. To break both of those could really create a little bit of bedlam in the markets. And I think NASDAQ is worthwhile taking a look at this stage, still in an upward trend overall, though, for the NASDAQ. So that's important to note. Still technically in an upward trend, but we came perilously close in the last 24 hours. What about ES? Well, this is the S&P 500. I'll quickly just use the S&P 500 here, the real one, just to demonstrate the point. We still have a very key level sitting around that 4110, 4140 zone. We also have the 61.8 fib of the entire pullback, which is what we've rejected so far. Interestingly, it also rejected where it started the sell-off after the CPI number back over here in, what date was that? That was the 13th of September. So we actually hit this kind of like random zone, and the 61.8, we've kind of fallen off. There's not much structure in here. So it's not like we have previous supplies or previous orders sitting in the system as much as we thought. It could be just consolidation for a massive rip up. And if it is, I mean, this is where the bulls should be committed to the trade, because anything when it gets underneath here, it could trigger further shorting that could then fill into the gap. And maybe if you're a longer term bull, you're looking at this saying, okay, I now want that price. Maybe that's going to happen for you. Set alerts, be ready. So if it does happen, you have your plan in place. Let's have a look at the 2 hour here. If you have a look at the Twitter and check it out, you'll notice there was something I did in this one. But basically, there's a fairly concise demand zone. At this point, it's recovering. What you want to see if you're about is you want to see a series of lower highs. Basically, you want this market to drop off here. And if it does, that's significant because it's showing you weakness. And of course, the bears are getting more in control. If you're a bull, you want to see this level taken out. And that should solidify a new high, you would think, because taking this level is going to be relatively important. Once you take that, you're taking this as well. And then you're solidifying that real potential to get up to that fill of the gap. And that's something that we've been talking about as an extreme point. It really depends how many retail traders are short right now. If everyone's trying to short this, the market will squeeze them out. That's traditionally what happens. Unfortunately, we can't get the clean numbers. I tried to in the last 24 hours. They were just not clean enough. And I don't really like reporting on unclean numbers. But in general, most of the data I found was that retail traders are net short throughout this area. So we have to be careful here. We have to be incredibly managing our risk as much as possible and being sharp and quick. A fall below this area, if it's not instantly rejected, could seriously spell some problems. Just be careful as well in here. There's a 3,900 zone, what could be a demand for this market. S&P 500 moving into the big options expiration. This is one of the big problem zones, 390. We have puts now outweighing the calls here. Obviously, max pain sitting at 385. This is the only week you'd possibly look at that because you got 5 million units plus of options. That's a lot. 400, 410 tend to be the top end side. And you would think the market would like to hone itself between that 380 and 400 this week. Something in there that is beautiful for the composite man. That would be exactly what Wall Street would want. They would be like, yes, I make the sweet money. Because remember, who sells options? It's generally Wall Street and the market makers. It's not traditionally retail and quite a lot of other unsophisticated investors. It's Wall Street that's making the money here. Let's move over to Bitcoin. Just gave this kind of the last day. I want to talk about the idea that Bitcoin's in kind of a massive cycle. Of course, our base case is 84 to 86% down. Our base timing is kind of soon. I've said a few times I thought that we'd see the base before February of 23. I still think that's statistically the most likely kind of thing to occur. But it's a very interesting time. Negative 77%. Is this a time that you should be freaking out in the crypto market? Probably not. It's already at negative 77%. That's not too bad. I mean, you're talking about only a matter of a few percentage points further down to, really start to hit those statistical averages. But we don't know if we've seen any real signs of recovery. Let's have a look at this. Now, a lot of people will start drawing this as some kind of wedge, and they'll be saying, we've got a series of higher lows, and we've got a series of, at the moment, lower highs. So we're clearly coming into some form of, big breakout way, something like that. If the stock market breaks up, of course, you're going to have to expect crypto will come with it. If the stock market breaks down, then you would expect the crypto to fall further. It's an interesting point. We've seen the max fear. We've seen the low. Usually I like a secondary take if that's going to go long. And I still think you got to be very, very cautious here. For long-term investors, they might like this price. For traders, I just don't know if there's enough edge in this market right now. Still, we've got issues around 18,000 for shorts. You've got 17,600. Those kind of levels will be problematic. And you can see in previous history, when these types of things have occurred, how markets have played out. So you're often getting those kind of higher lows, then like similar type of triangle here, and then dumped off for a final sell-off, rallied. That's fairly traditional with price action. So make sure you think things through critically. Often markets have come down a few times for the low. There's a classic stop hunt version. There's the max fear, does some stuffing around, comes down and gets it. That's the way that markets tend to like to form bases correctly. We haven't seen that yet. So I'm being very cautious here. As we mentioned, core retail sales came in pretty hot. We got a 1.3%. Expectation was 0.5 and 1.3 versus 1 for retail sales. I don't think the US economy is weak. I just think it needs to be weaker for the Fed to achieve their goals. Philly Fed Manufacturing Index, that may mean higher rates in the future. That's why it slightly spiked up. Philly Fed Manufacturing Index on 8:30 a.m. New York time, Thursday, November 17th. And then, of course, that really ends the major news for the week ahead. Yeah, there's a lot going on in these markets. Remember to go and follow us over on the Twitters at FX Evolution if you're interested. Trying to get to 10K. Be awesome if a few of you guys would go over there and get us there today. It's possible if enough of you pay want to go over to the Twitters. It's a good place to be. And I actually think it's one of the best social media platforms for traders and investors out there. There's some great information that comes out of many people on Twitter, and hopefully you enjoy our account. Thanks so much for subscribing, smashing that like button. We'll see you in the next one. Bye for now.